All right, so we're getting to the end. We're going to have this lecture, then there'll be the following week will just be a review of the course to prepare you for the final exam. I'll be posting all the stuff in regards to how to turn in the final set of homework. The podcast is obviously up there, and the term paper. So we're getting down to the end. There's a lot of things that kind of fall through the cracks in terms of personal finance that you may find yourself in. This is by no means going to be all inclusive of everything, but for a lot of people, and I think it's become more relevant as people go, and especially here in Alaska, I think people are maybe a bit more entrepreneurial than other places where you might end up setting up your own business or doing some other things, or certainly be involved in real estate. Hopefully, at least to the extent that hopefully you'll own your own home. I think in most situations, you're going to find out that real estate is advantageous, and it's really where a lot of people are able to pass along generational wealth. There's a lot of segments of in the U.S. and the society where housing is not a part of people's lives, either due to government providing housing or whatever, and it sort of locks those folks into a cycle of poverty because you're really not getting anything for free. You're not investing in property, and you have nothing at the end, and you're utterly dependent upon others for your shelter and stuff. So it's not a great position. The real estate, and part of it's due to the lobbies and stuff, where there's a lot of advantageous laws in real estate in terms of taxation that you probably want to take advantage of. So we'll go through and talk about some of those details. One thing that's actually more relevant now, I've never been a big fan of gold and silver. I've always had just a little bit, but part of the problem with that is just the performance of it compared to the stock market. But we're kind of in a new era now where stock markets are not quite performing as they would. Collectibles, we'll talk a little bit about that. Speculation, speculative stocks, a lot of fun, but don't confuse speculation with investing. They're different things. Cryptocurrencies becoming more and more relevant, and then real estate. And then the big thing that's always been out here is inflation. You have to do something with your money. If you just stick it away someplace, you may derive some comfort for having the cash on hand, and nobody can take it away from you. But what you're not realizing, and I hope you realize after this course, is that it's being taken away from you just by the buying power of it. The inflation is degrading the buying power of it continually. So this is one of the reasons why I'm not a huge fan on gold. Now, as you know, it's up right now. It's popping a little bit, as it should, but it should have popped a few times beforehand. But anyway, if you look at the performance of it, it's not that smooth trajectory going up. I mean, back in 2009, you see there was a peak, and then it just waffled. And if you were investing in this whole thing for this past 10 years, you kind of broke even, and then a dip, and then back and forth. So the way gold is supposed to work, and believe me, especially with podcasts and everything else, there's probably not a podcast out there that's not sponsored by some gold company. But anyway, a lot of times the way gold and precious metals are supposed to perform versus how they actually perform are two different things. One of the things about gold is it's supposed to be this hedge against inflation, and when the economy goes down, gold is supposed to go up, and that correlation, there's a lot of big traders involved in this that prevent that from happening. And then also there's a lot of industrial uses for gold, and especially silver, where you know, those things are supposed to, the precious metals are supposed to go up when the economy goes down. Well, when these things are used in electronics and all sorts of, you know, gold and silver have unique, you know, electrical properties and other properties that, you know, beyond the scope of this. But anyway, it creates huge industrial uses for those metals that when the economy goes down, demand for those industrial metals goes down. And so the gold prices go down just like the rest of the economy. Who knows? You know, they call these people gold bugs. They've been patiently waiting on the sidelines for gold to take off. And it's up some now, but man, to have, you know, spent this entire time when the stock market was on such an upward vector for the past 20 years or so, it would have been unfortunate. And then also there's the storage issues and some of the other things. I get the whole prepper thing, but I'm just saying if you know, if we're faced with some sort of apocalypse and you know, gold's the only form of currency, and you go down to the gas station with your gold to buy your fuel, you're quickly, unless you have guns to protect that gold, you're going to lose it. Now, I've talked about inflation, and part of the reason has to do with the money supply. When you put as much money into the economy, and you know, again, we could argue about whether it was necessary or not, but post-COVID, so much money was poured in the economy, and it created quite a bit of inflation. So you can see from the chart where it basically just goes exponential there at the end and right off the chart. So that was going to cause some inflation, and you know, other things to include gold have not kept up with that. One other issue that we don't talk about at all, and I'm not sure that I just want to mention it. Some of the collectibles, these could be, you know, again, well, could be, you know, jewelry, guns, stones, carpets. I would spend a lot of time in the Middle East, and I had so many friends who bought all types of, you know, these Persian rugs and just other collectibles. And in Afghanistan, for example, everybody was always trying to sell you precious stones. The problem was that the counterfeit issue over there in the Middle East was a real problem. The other problem is the market for some of these things is kind of sketchy. There are some new types of funds that are actually investing in fine art where you can, you know, hold a position in some sort of fund, but this is going to take a little bit of legwork. These are not going to be, you know, regulated by the Securities Exchange Commission. This is going to be kind of difficult. And that part about requiring a willing buyer and liquidity, able to turn your collectible into cash. I mean, I get it. Some people are very skillful at collecting, say, you know, antique firearms, you know, old guns and things like that. You know, good on you. But it's again, it's kind of difficult at some point to always have a buyer. And inherently, if you're going to have those collectibles, you know, if you want to have them around to enjoy them, but you're also going to have to secure them and insure them and the rest of that. So it can be a component, but it's going to be a little more difficult. I just know, for example, when I was involved in these Persian rugs, the people, you know, my friends were buying thousands and thousands of just these amazing rugs. Me with dogs and animals, I just can't do it. They'll destroy things. But anyway. Speculative stocks. One other thing. So, stocks, the Securities Exchange Commission and the rest of that, they regulate stocks and they make sure information is you know, essentially correct by having stiff penalties against people who or in positions of authority. You get somebody who's like the CEO or, an officer within a corporation, and if they make comments about their stock publicly, and they're proven to be untrue, they can go to jail. I mean, it's quite serious. Now, there are some segments of the investment community and stocks down in the lower end that aren't regulated by the SEC, where people aren't under that sort of legal bind if they make false claims. And we're down in the penny stocks and stocks that aren't listed in the big exchanges. And again, the Wolf of Wall Street, whatever. I'm not a movie critic, but the one thing it was pretty accurate about was the kind of the backstory about the pump and dump. The reason all these people generated all this money was essentially by lying to folks. They would take a small position, or small amount money wise, but a large number of stocks in a penny stock type thing. And penny stock is a stock that's just, it could have been around for a while, but it's trading down literally in the pennies, less than $1 typically, not listed on any exchange, and not a whole lot of public information, and certainly not a lot of truthful information out there. And they can just pump that stock. They can talk about how this is the next big thing, and they'll get the stock price to rally from a couple cents up to, whatever, a dime or something, or maybe a buck. And then all of a sudden, the momentum takes off and people are truly making money. But greed's a horrible thing. People don't jump out. They don't jump out when it gets to a buck. They're like, oh, this is going to go to $5 and I'm going to. So anyway, people get wrapped up in on this, and the people who are, orchestrating the scheme, they cheerlead this on, which is exceedingly easy now with the internet and some of the, Wall Street bets and some of the other things. They'll get in there and really get behind the stock. And these people know, the initial investors know, that intrinsically there's not a lot of value in this company. There's a reason why it was only valued at a penny. Anyway, it doesn't matter. This is just the vehicle to get this stock up to 10 or 100 fold, and then boom, they sell. The original investors sell everything all at once in a hurry, and it's supply and demand. Now all of a sudden the market is flooded with this stock. These guys have gotten out. The price absolutely collapses. The market, basically resets itself to the intrinsic value of the stock, which is probably not much. And these guys walk away with a big stack of cash and go look for another stock. So the problem with these is that they're very appealing. They're great when you're at work and you're bored and you're talking to your coworker and they've got this hot stock and they're telling you how they've already made, some 10x return. And this can also happen with some of the non-Bitcoin type crypto things where it's the next big thing. And so you have to be very careful with this. Now, I'm not saying absolutely not to do this. I'm saying this is the same money that if you're a gambler who would go to Las Vegas or somewhere, find a dog or a horse track. This is that same class of money. You're gambling it. This is money that's basically spent. This is not investing. You are going to, in all cases, almost lose this money. So don't, if you've invested your 10% or paid yourself first, invested everything wisely, and you've got a few $100s left or whatever it is, you're going to go waste it on something. Speculative stocks are another avenue to waste the money. Don't fool yourself that this is a great investment. So anyway, futures and options, kind of the same thing. These are actually a useful tool for investing. I haven't talked much about futures and options. I've actually bought options, and they can be fairly useful because your risk is limited. And if you've got, these are somewhere in between, hardcore investing and speculation, because there is a bit of gambling, but again, they are a credible investment. Futures, on the other hand, futures are a kind of something for the big boys to get involved in. Somebody with deep pockets who realizes the risks involved. So, let me just give you a quick overview of what a future is, a stock future. Or it could be, a lot of times they're used in commodities. Let's say you're a big airline, you're Delta Airlines, and you want to sell tickets. You could go online right now and buy tickets for travel for, pretty much a year from now. Well, how is Delta Airlines going to be able to set ticket prices when a huge component of their expenses are fuel? And they don't know what fuel is going to be a year from now. They can guess, they can estimate, but how do they set ticket prices? If they, sell tickets for airfares a year from now and they have no idea what the fuel is going to be, they are the ones speculating because they're selling an unknown quantity. They don't know how much these flights are going to cost them. So what they'll do to give them some stability, since their core competency is in the airline business, not in the fuel speculation business, they'll go ahead and say, jet fuel's trading for, I don't know what jet fuel's going for right now, but let's say it's $6 a gallon, right? And in order to get some stability in their pricing, Delta can go out there on an exchange and they can say, we will pay $6.50 a gallon, so maybe a little bit over the prevailing market right now, if that makes sense to them. They'll forecast all this. But anyway, they'll say, we'll pay $6.50 a gallon for, $1 million of jet fuel with a delivery date of April 2024. So a year from now, whoever takes this bet, and essentially that's what it is, they will have to somehow deliver, to the depot or wherever Delta demands it, $1 million of jet fuel at the specified price. And so that, if they're able to sell this to somebody, then they know for certain that they will be able to buy that jet fuel at that price. And so they can take that pricing component out of their out of the confusion. That's one known quantity now when they're setting their prices. And so they're going to have to, when I said $6.50 a gallon, they have to come up with a price that, obviously they want the minimum. They don't want to overpay, but they have to come up with a price that is attractive to a speculator who's going to go ahead and purchase that futures contract for that delivery of that fuel. And, once that's sold, then Delta's happy. And the speculator, if jet fuel's still trading for $6 a gallon, or maybe the price drops, let's say it's $5 a gallon, that's good for that speculator, right? He can buy the stuff now at $5 a gallon, and Delta, by their contract, has to pay $6.50 a gallon for it. If that price goes up to $8 a gallon, things got quite ugly for the speculator. He purchased that $1 million or million gallons of jet fuel and pay whatever the market price is, say $8 if that's what it is, and he only is going to sell it. Delta's only going to pay them $6.50 a gallon for it. So this is where the risk is unlimited. If fuel doubles, if it goes up to $12, that person, that speculator who did the futures contract, still has to purchase the fuel. They're bound contractually to do that. So that's where I'm talking about. This is not something for small time investors, because you can't get out of it. You do have to deliver, and that's a problem. Now, options give you the right but not the responsibility. So in this case, there's a reason for an option. You have to pay a premium, and there's a time constraint, and there's some basically fees involved and some premiums involved for you to purchase this right but not the responsibility. So it'd be the same sort of thing. If you could put forward amount of money to guarantee your ability to purchase, but not the responsibility. An option could be used similar to a futures in commodity pricing, but it could also be used maybe in a real estate deal. Let's say your neighbor has got a home that they're going to be selling, and you've got some things going on. Maybe you've got some, you're not quite ready to buy just yet. You've got some money coming, but it's not with you right now, and but you don't want you want this next door neighbor's home, but you're not prepared to do it just right now. You can negotiate basically a form of an option. You can go to your neighbor, and let's say they're selling their house for $350,000, and you can go to that neighbor and say, look, I want to potentially, I'm buying just an option here, the right but not the responsibility. I want to potentially buy your home for your asking price for the $350,000 within the next 6 months. But this is just an option. I can back out at any time. So I'm going to pay you $1,000 for you to not put your house on the market and give me the first option to buy that home for $350,000 for the next 6 months. And let's say, your money doesn't come through. You decide you don't want the home. You just don't buy it. And at the end of 6 months, your neighbor is free to put the house back on the market. But alternatively, if you 6 months from now or getting close to it, before the option terms have expired, you decide to buy it for $350,000. You go ahead and purchase it for $350,000. Now the neighbor still keeps the $1,000 in addition to that, but anyway, with that $1,000, you went ahead and secured the right but not the responsibility to execute that purchase. So there's a lot of times that this will work. It can be done in stocks as well. You can take an option to, let's say, a stock is you think it's on this upward vector, but you don't have that much cash. You don't want to set down a whole stack of cash buying the stock and being tied to the stock that's, say, trading for $500 right now. It's going to go up to 700 or whatever. You're sure in the next couple months. Well, it could also go down to say 300 or 400, so you could lose your money. But you've got some confidence here. You want to buy an option. You want to buy an option to buy, say, 100 shares of that stock within the next 6 months for, let's say, $600. It's only trading for $500 right now, so you could probably buy this option. It's an out of the money option, meaning it has no value right now because nobody's going to execute this option to buy, the $500 stock at $600 right now. But you're confident this price is going to go up to $600, $700, $800. So you go ahead and pay a fee, and you get this option to buy that stock at $600. And let's say your assumptions prove correct, and that stock price just rockets up. It's now trading for $800. You go ahead and execute that option. So it's trading for $800, and you paid a fee for that right, but not the responsibility to buy that stock at $600. You go ahead and execute that option. Now, the person who offered that option, they're kind of screwed, yeah, but they took your money and they took the other side of this bet, basically, and they have to purchase that stock for $800 and sell it to you for $600 per the terms of your option. Now, if the stock never takes off, if it stays at $500 or drops or whatever, you just let your option expire worthless. You're like, yeah, I was wrong on that one, but the good news is I only had an option, so I didn't lose any money. So anyway, if you really want to get down in the weeds and start trading stocks and stuff, and you want to use some of these more aggressive strategies, options are one way to not only have potential for huge upside risk, but also manage your possible losses. So anyway, I just want to talk about that. But futures and options, they are popular out there. My problem with futures and options are that I'm not, perhaps I'm not in the right place. Most of us aren't, in terms of access to the market and all the data and concentrating on this 24/7, and that's why some people study these things, and they become experts, and they kind of have a good idea of what's going to happen, or a better guess than me perhaps on what's going to happen in some of these markets. So they're in a better position, and with options and futures, it's typically a zero-sum game, meaning that if I win, the other investor loses. And in most cases, that other investor who's offering or buying that option, they're probably doing this full time, and they probably have a pretty good track record. So in my mind, I'm kind of fooling myself if I think I'm going to come in as the outsider and be able to outdo some of these professional investors. Maybe not. Maybe I've got some unique insight. Maybe I'm really into this, but it's not the same as investing purely in the stock market itself. I can invest in a stock, and that price can go up, and I can make money, and so can the big investors. It's not a zero-sum game. When the stock price goes up, we all win. And so if I'm getting insider information, and now I'm agreeing with these other investors, I'm more confident. In a futures or options strategy, I'm confident that I know more than they do, and that they're going to be wrong, and I'm going to be the one to be right. So anyway, different things. Cryptocurrency, the new gold. This is part of the reason why some of the gold bugs are pretty disappointed. Is Bitcoin a store of value? It's doing pretty well again. It's up above 30, and it seems, I don't know. I'm pretty confident. I bought 2 Bitcoins way back when for $700 a piece, so I didn't get in at the bottom, but whatever. When it doubled, or not doubled, it went up to like 2,600. I said, that's 4 times my money. I'm selling one of them. So I've got 1 Bitcoin and a bunch of Ethereum and other stuff, but. Anyway, there's a lot of things that can be done with Bitcoin, and a lot of the decentralized finance, where can change banking and loans, and they're pretty powerful. So I'm kind of a proponent of crypto, but it's a wild ride. It's not probably it is not where you want all of your financial all of your investments. Is it speculation, or is it investment? It depends. But I think Bitcoin's getting to the point where it definitely has investment qualities to it, and it kind of has displaced some of the attributes from gold, because people are tending to store money in it. But a lot of political opponents. It's very disruptive. It's there's a lot of, as central digital currencies prevail, or not prevail, but as they enter the marketplace, there's going to be a lot of knives out trying to take down Bitcoin. But there always have been, and they haven't had that much success yet. So could be a game changer. Anyway, it could be part of your investment portfolio as well. Real estate. So real estate, of all the things we've talked about, this is the one that, again, is something that is very secure. Now, there's always going to be wild markets, in certain sectors, but those are known quantities. If you're investing in, Las Vegas or Miami Beach or certain areas that are known to be exceedingly volatile, yeah, in Alaska and most other places, probably not so much, not quite as wild. When market goes down 1% or 2%, people just they act like it's the end of the world. Whereas the stock market or crypto can go down, 50%, and it gets the same reaction. Real estate transactions are slow. We've talked about the lack of liquidity. An inherent hedge from most inflation, it tends to go up with the market, and potential to enhance your life. So again, an investment that not only can you look at a bank statement, you can actually live on it. The thing about the inherent hedge against most inflation, and this is where ideally mortgages are a part of real estate, using borrowed money. Let's say you wanted to purchase a house for cash, and your dream house is $500,000, but right now all you can qualify for is $250,000, and so you're tempted to wait and wait till you can get enough to buy the $500,000 house. Well, in that waiting period, inflation is going to take place. So let's say it's a hot real estate market, and you take the middle option here. You decide to buy the $250,000 home, and you're pretty excited because the market's going through the roof, and your $250,000 home doubles in price. It's up to $500,000, and so now you think, I'm going to get that, my dream home that was $500,000. Well, that dream home now is worth $1 million, and so initially you started out $250,000 behind. Now you're $500,000 behind. So inflation is a bad thing. Now the worst case scenario would have been the person who just sat on the sidelines and did nothing and was trying to save up the cash to buy that $500,000 house that's now $1 million. You're even further behind, and you haven't been involved in the market at all, so you are really far behind. Ideally, with real estate, if you had a stable income and a fairly stable life where you're not moving around a whole lot, you could perhaps purchase your first home being a starter home that's going to be a future rental. When you buy a home as an owner-occupier, especially a first-time buyer, get all sorts of deals. You're going to go lower interest rate. You're going to get all of that. You live in that home for a few years, and then you move on to your second home. And rather than sell that first home, maybe you keep that as a rental property. And you start doing this process maybe 3 or 4 times, and you end up with a portfolio of rental properties. And all these rental properties, when you purchase them, you are actually living in them. If you go to the bank and say, I want to buy some investment property for a rental, they're going to say, sure, but the interest rate is going to be about double what owner-occupied home is going to be. And it's going to be very difficult to make those investments because of the interest rate that you're going to have to pay and the qualification requirements and all that. When you're owner-occupied, it's far easier. So when you let's say in this case buy your second home and you turn your first home into a rental property, they don't come back and renegotiate the loan. No, the loan is the loan. That low interest rate stays. And so you could have that home for the entire term for, if it's a 30-year mortgage, you could have that 30-year mortgage at that low rate. And so that's why it makes sense in a lot of times to do that. Jumping around a little bit more, this is just something that if you're going to do any entrepreneurial stuff, there's different types of business formation. Sole proprietorship, let's say, you're going to do Bob's Painting, and you're just going to put your name on the side of the truck and start painting, and you're going to be one owner. All of your income, everything is going to be taxed under you. Liability, you and the business are one, so if your ladder falls off and somebody runs over and it flies through somebody else's windshield, anyway, you are out of business. They're suing you. They're taking your house. They're taking everything you have because you have unlimited liability. And, oh, by the way, if you happen to die, your business died as well. And so transferring that over to your heirs is it's going to be more difficult. So, but it's easy to do. You know, just go down there, get your business license, your sole proprietorship, because you haven't done anything else. Partnership, a lot of the same type of things. Now it's just spread apart by two people, and you two people who have to cooperate, which is that could be difficult. So, not a big fan of sole proprietorship, partnership, but corporations. Corporations are an entity unto themselves. They can be small corporations, large corporations, C-class corporations, or just a limited liability company or an S-class or something like that. I'm not going to go into huge details on this, but the reason why most people will incorporate their business is for the tax and liability purposes. You've got a legal entity that it's its own. It can go to court. It can be sued. But let's say that ladder falls off your truck. They could take all the assets related to that business, all the assets that are under that LLC, but your house and your future income and the rest of that, no, that's not part of the entity that's being sued. So that's kind of a no-brainer why you don't want that. Also, for transferring on to your heirs, if you set this up properly in your estate or your trust or your will or whatever, this could transfer seamlessly right over to whoever or be sold to whoever, because it's its own entity. It's not tied to your natural life. The taxation, there are things that can be done. There is one disadvantage in a corporate tax system that leads to double taxation, because this entity is taxed and then the money that's passed through to you is also taxed as personal income. So the tax situation can get more complex, but most companies are either, not sole proprietorships. S Corp taxed as a partnership, limited. So I'm actually an S Corp. I should know more about it, but it gets a little more complex, and you do need an accountant or a CPA or somebody to keep you out of trouble with the IRS. LLC, again, another form of has the same sort of situation as a corporation in terms of liability. So, sole proprietorships, just a quick review. Yep, small. People are lazy, so that's why 3/4 of companies are that. Here's the big factor. So, yeah, pictorially. Easy. Taxed individual rate. Dissolved easily. Which is a good or a bad thing. Unlimited liability. Difficult to get funding because the company itself is kind of fragile. It's just one person. Higher taxation rates since it's all reported as personal income. Partnerships. You see a lot of law firms do this. You see some dental practices do this. Again, not a tax lawyer, but the one thing I will tell you is that don't end up in a sole proprietorship just because it's easy. Look for one of these other business forms. I was actually in a partnership at one point, and part of the problem with that too is the liability. I was a limited partner, and some of the things they were asking me to do would have crossed that limited partner, would have made me an active partner, and would have increased my liability. If you're a limited partner, it's similar to a corporation where you're only liable for the assets you have involved. And that was key to this partnership because the real estate is a big real estate trust, and it went south. And I would have been on the hook for a lot of money, more money than I had invested. Because I was just an investor, I actually got out before the bad things happened. But the worst case was I would have been limited to just the amount of money I had invested as a limited partner. As a full active partner, my liability would have been unlimited. So unlimited liability since they're an active partner. Responsibility for each other's decisions, which I don't want to be involved in. Yeah. And that's the other thing, difficult to sell. You may agree greatly with this other partner, and then all of a sudden he or she sells out and you've got this other person. Yeah, I just don't do it. So anyway, we're not going in depth in this, but I'm just trying to give you a brief overview. But regardless of what you're doing, you're going to be in some form of corporation. Corporation is kind of the umbrella term for these other forms. I mean, corporation has specific, meaning, but there are a range of corporations. Not all of them are the big publicly traded buying and selling shares. Some are privately held corporations, or some are the smaller forms of corporations. But the corporation is a legal entity, and so it can enter into contracts, sue and be sued, the rest of that. They can sell stock, they can offer dividends. Creating a corporation is super easy. Easier probably than it should be. Pay it's typically about $250. You file the papers online, fill in some of the details, and you're incorporated in the state of Alaska. A lot of times people will choose to be incorporated in the state of Delaware because Delaware is a very business-friendly state, meaning that, nicely put, that they kind of screw the consumer. They don't look out for so much for the individual. They favor the corporation. And so if you're dealing with a Delaware corporation, keep in mind the reason those people probably set up in Delaware is because they wanted someplace that was going to be very friendly to them. The court system is very friendly in case they get in trouble. Domestic corporate is not going there. Private corporation. So there's certain companies, if you're into drones and stuff, DJI is a corporation. They make great stuff, but you can't invest in them. At least you couldn't last time I checked, because they're a private company. A private company can become a public company through an IPO, initial public offering. They can sell that stock and do all the compliance with the SEC and knock all that out if they're getting larger. Public corporations, so nonprofit corporations, a lot more to it. Board of directors, yeah. Preferred stock, we're not going there. Common stock. Advantage of corporations, though. Limited liability, ease of ownership, perpetual life, securing funding because it's a stable entity, expansion potential. You can sell shares, raise capital. So there's a lot of things. This is why they're smaller in number, but they're bigger in dollar volume. Double taxation. So the corporate profits are taxed, and then when they're passed through to the employees, the owners, they're taxed again. Can be. It depends on the size. But, economies of scale. If it's a big entity, not so bad. If you're going to be a publicly traded corporation, a lot of things are going to be open to the public. And if that's important to you not to have that done, then maybe not the same. Joint ventures and S corps. So, LLCs. Cooperatives, this is typically, when you think of cooperatives, a lot of times it's agricultural cooperatives where they're putting a business together, but not necessarily for, it's to become part of a joint group, a larger organization. So, the one last thing I really want to talk about is the real estate purchase process. You are going to, hopefully at some point, be involved in this. As a salesperson up here, I can tell you a few things to look for. First off, the search for the home, the first thing you should do when you decide that you're thinking you're going to buy a home is secure the financing. Now, this is just a pre-approval, so they'll charge you for the cost of the credit report, probably about $50. So you find a lender, a local lender, generally local, because the rates are going to be nearly the same, and they've got some skin in the game, and they know the market, and they can hopefully get this thing closed. Most real estate, salespeople, agents are going to prefer using a local lender because a lot of times they know the people, and they can get the loan pushed through when, if it's some online service, at least at this point in the terms of the maturity of the online lending system, the local guys can normally get it done. Don't be under the illusion that it's going to stay local. It's probably going to be sold off. Loans always used to be sold off to Wells Fargo. Now it's Freedom or some of these other companies, but it doesn't make a difference to you. The payments don't change, but about a month after you bought the house, you get a letter in the mail saying, hey, we have bought the loan from Home State or Residential or whoever the local person was, and we now own the loan, and you now make your payments to us. So, other things about a home, location is key. You want to, look at a home, and the strategy is especially if you're looking for a rental property, a future rental property, is make something that's attractive to not only you as the buyer who's going to live in it for maybe a few years, but also for future renters. So, you may say, I don't care about schools because I don't have kids. Well, yeah, you're going to eventually be selling this property or renting this property to somebody who might have kids, and so schools are important. And it's also going to affect the market value because anybody buying the home is going to be looking at schools. So don't buy anything too unique. There's also a strategy to kind of buy the middle home in the neighborhood. You don't want the most expensive home, nor do you want the ugliest home on the block. You want somewhere in the middle. That's going to be the one in terms of appreciation that's probably going to go up most consistently. And there's a tremendous market for homes, say in the $400,000 range. You get up in the $1 million range, and there's only a few folks, and they're very slow to act, and they're selling their previous home, and the real flow, the real turnover is down in those mid-priced homes. So that's what you're doing. Using a real estate agent, I don't sell real estate anymore, but I would still definitely recommend using a licensee because you're not paying the commission. The seller pays the commission. So if you're looking at a home, it doesn't hurt. Even though maybe you're a lifelong resident and you know everything about the area, there may be some insight that they could provide that might help you out. And then also, unless you're looking for sale by owner homes, you're going to end up paying a commission anyway. I can tell you for most of for sale by owner homes that for the most part they're overpriced. What would typically happen is I get called, somebody says they want to list a home, and their home's in the $300,000 range. They want to sell it for $450,000. I go out there. It's like, yeah, I've done the market analysis. This home won't sell at $450,000. They get insulted. They say, well, screw you. I'm going to sell it myself. And so they do. And so I'm not saying that's all cases, but, the savings you think you're going to grab because they're not having to pay a commission, a lot of times they're trying to save some money, but are they going to pass that along to you as the buyer? Not always. Zillow and some of the online services, the services aren't mature yet, nor are the laws in Alaska conducive to some of these online things. In other states where, they have, in Alaska, it's a non-disclosure state. So whatever you sell something for, you don't have to state that to the government. They have to, if they want to determine the market value for, say, taxing you, they have to establish that value themselves. You're not under an obligation to report the value. So it makes it more difficult for some of these online companies who would normally just look at the tax information or the public information to find out what the house sold for. You can disclose it if you want, but in most cases, these guys are working on imperfect information, and so their estimates a lot of times are way off. Plus, they don't know an avalanche from a whatever. They don't know what property is perpetually in the shade. They don't know the value of different neighborhoods. It's just it takes more of an in-person approach right now. They may get to that point, but they're not there yet. Disclosures. If you have a agent involved, that's a good thing, because agents, when they go to court, will typically lose. The courts will typically side with the individual, the buyer or whatever. So if there's, say, a defect, that this roof leaks, the seller knew about it, the agent should have known about it, you buy the home and it's got this huge leak, that's probably going to end up in court, and that seller and the agent are going to end up having to pay because they didn't make the proper legal disclosures. When you sign the whole contract, those things, known defects, are supposed to be disclosed. So if it's a for sale by owner, the owner, he's not a real estate professional. He can't necessarily be expected to know the significance of reporting all these defects, and it may be a toss-up when you go to court. So anyway, you're probably going to get a fuller disclosure because the poor agent is just scared and will make sure that they over disclose rather than be subject to a long protracted court battle that they're probably going to lose. Whoops. Appraisal. There's always an appraisal done when there's a loan involved. Don't get too much satisfaction from having your property appraised, for right at what you offered or something. The appraisers know what the price is, what the price that you've offered, and they'll typically come in real close to that. And anyway, it's not a perfect game. It's not that they 100% objectively go out and establish the price of the property. A lot of times it's influenced, and it's for the comfort of the bank and the rest of it, but it's not a perfect process. Inspections, especially in the wake of earthquakes and other things that may have had some serious structural damage, you not only need a home inspector, but you need one that knows more than just the positioning of say wall outlets and things like that. When I've purchased a home, in most cases I'll find an actual licensed engineer. I can fix outlets. I can move things around. There's certain things that you'll run into where the window size is too small in the bedroom areas for a fireman to come in with all their equipment, or the railing, the gaps are too big, and those things are important, and they may give you some negotiating power with the seller because they're out of code. But what you really have to be concerned with are any sort of structural defects that may be due to poor quality construction or the earthquake. So the big earthquake of a few years back did some damage to a lot of homes, and you need to know about that. So there's some inspectors out there that, and if you've got a salesperson, agent who's not necessarily the best, they may go with the home inspector who's known just to check outlets and just do a very surface inspection and come back with a very short list of defects. And then they know that there's some out there that are rigorous. But I don't want one that's going to be just picking up every little nitnoy, but I want one that's going to look at the big picture and not lose themselves in the weeds. Loan approval, commitment. Well, this should be fairly easy. If you went ahead and got the pre-qualification, you've got a letter that states what you can afford in a pre-approval. So this goes quite a bit quicker. You're just verifying all the documents you turned in, and this should be one step closer. So you didn't really waste any time by doing the pre-approval. You're going to have to do it before or after. But if you didn't do it until after, you could find out that you can't get approved for that home, or you could find out that the reason why no salesperson was willing to take you out and show you any homes was because you weren't very serious about the process, because you hadn't even got your pre-approval letter. You really didn't know what you could afford. And so let's say you're looking at a $400,000 home, and now you go in and finally do your loan paperwork, find out you can get a $500,000 home. You go back to the salesperson and say, hey, I want to start the search all over again because I can afford a bigger home. So you've wasted a lot of people's time. And so salespeople are cognizant of that. And so they generally won't waste a lot of time with somebody who hasn't done the pre-approval. Final walkthrough. Yeah, make sure everything's good to go. Again, there probably were some discrepancies that came up in the home inspection. I had a home one time where I was purchasing it, and the floor was jacked up in a certain bathroom, and they were just putting in some, crappy composite flooring when it had real hardwood before. I'm like, wait a minute, this needs to stop. If I would have closed on that home with the way it was, I would have been stuck with that crummy floor. But before the closing hadn't happened, I was able to get the, basically the craftsman to put in proper wood to replace what was going on. And then the closing. So the way the closing is supposed to take place is you were supposed to get all these documents beforehand, a couple, 3 days. If you just walk in there cold on the day of the closing, they are just going to be shoving document upon document in front of you, and you're going to be signing it. And it's going to be kind of stressful because you're going to not have time to read it all, or you're going to be confused by it. So you should typically get the documents beforehand. The other thing is that there's a whole bunch of federal documents that are kind of scary because it tells you how much you're actually paying for the home if you do all the math, and that at the end of 30 years, you will have paid $1.2 million for this $30,000 or $300,000 home, and part of that is accurate, but it's also the time value of money. Anyway, you don't have many options. If you're going to get a loan to do the home, you're going to have the time value of money, even though the interest rates are low. But unless you're able to kind of read and digest those documents over the course of a day or two, at the closing, they're going to scare the bejesus out of you. And then the term project. So those are the highlights I wanted to hit just before we close this thing out. The term project, you should be closing in on that. Like I say, if you have any, questions, follow up with me. I'm going to be doing the final exam prep next week, and we'll post that, and then we'll take the final online. And that's going to be it. Good luck until next week.